Two women started their careers on the exact same day, same degree, same starting salary, same 6% they each decided to put into their 401k every single paycheck, without fail, for 35 years. Diane worked for a small marketing agency, 40 employees. Priya worked for a national logistics company, 12,000 employees. Both picked the plainest, most boring option on their plan's menu, a broad market index fund. Not a risky bet, not a bad choice, the exact same category of investment. They retired the same year, and Priya's account had tens of thousands of dollars more in it than Diane's. Not because Priya was a smarter investor, not because she took more risk or picked a better fund or timed the market. Priya's fund and Diane's fund tracked almost the exact same slice of the stock market. Diane did nothing wrong. Here's the part almost nobody tells you when you sign your first 401k paperwork. The price you pay to participate in your own retirement plan has very little to do with your choices and a lot to do with the size of the building you happen to work in. Fee levels in a 401k aren't random, and they aren't primarily about which funds you pick. They're driven heavily by plan size. And by the end of this video, you'll understand exactly why two people can save identically, invest identically, and still retire with meaningfully different amounts of money, for a reason neither of them ever chose. You have to understand what a 401k fee is actually paying for, because it isn't just the cost of investing. A 401k plan has real operating costs behind the scenes. Someone has to keep records of all employees' contributions and balances. That's called record keeping. Someone has to handle the legal compliance, the government filings, the plan documents. That's administration. And someone often provides investment advice or plan oversight. That's an advisory fee. On top of all of that sits the cost of the investments themselves, the fund's expense ratio. Now here's the key fact that changes everything. Most of those operating costs, record keeping, administration, compliance, cost roughly the same dollar amount whether a plan has 40 employees or 12,000. A record-keeping system doesn't get 40 times harder to run because a company has 40 times more employees. The work barely scales, but the number of people splitting the bill scales enormously. That means those flat costs get divided very differently depending on plan size. At Priya's company, with 12,000 participants and hundreds of millions of dollars in plan assets, those fixed costs get spread so thin they're barely noticeable per person. At Diane's company, with 40 employees and a much smaller pool of assets, the same kind of fixed costs get divided among a tiny group, and each person's share is dramatically larger. This is not a fringe observation. It's one of the most consistently documented patterns in retirement plan research. According to industry benchmarking data compiled in sources like the 401k Averages book and studies drawing on Brightscope and Investment Company Institute data, employees at small businesses have been documented paying total plan costs of roughly 1% or more of their assets per year, while employees at large companies with huge asset pools can pay a fraction of that, in many cases well under 0.5%. Put that in plain numbers. Priya might be paying somewhere around 0.3% to 0.4% a year. Diane might be paying 1% or more. On the surface, that gap, less than 1 percentage point, looks small enough to ignore. It is not small enough to ignore. And the reason why is the next part of the story. Here's where the story flips from mildly annoying to this actually cost me real money. A 401k fee isn't charged once. It isn't a flat dollar amount taken out of your paycheck and forgotten. It's charged as a percentage of your account balance every single year, which means it's charged against an amount of money that is supposed to be growing. You are paying a toll not just on what you put in, but on all the growth that's supposed to be compounding on top of it. This is why the U.S. Department of Labor built a specific illustration to warn people about exactly this dynamic. In its published guide on 401k fees, the DOL walks through an example. A worker starts with a $25,000 balance, contributes over a 35-year career, and earns a 7% average annual return. If that worker pays fees that are 1 percentage point higher than an otherwise identical plan, their ending balance is reduced by roughly 28%. Read that again. 1 percentage point of extra fee. Not a scam, not fraud, just the ordinary difference between a well-negotiated large company plan and a typical small company plan can shrink a retirement account by more than a quarter over a career. That's where a title like 30% comes from. It isn't hyperbole. It's close to a documented government illustration of exactly this mechanism. Now apply that to Diane and Priya. Diane isn't paying some outrageous fee that would show up in a scandal headline. She's paying something close to what the industry average looks like for a small plan, maybe 1% total, compared to Priya's 0.3% or 0.4%. That gap of roughly half a percentage point to a full percentage point, compounding silently for 35 years against a growing balance, is enough to separate their retirements by tens of thousands of dollars, without either of them making a single different decision. And here's the detail that makes this land even harder. This isn't only about the visible fund expense ratio on your statement. Many 401k plans historically have involved something called revenue sharing, where a mutual fund company pays a portion of the fee it collects from you back to the plan's record keeper as compensation for being included on the plan's investment menu. Small plans, with less leverage to negotiate lower record-keeping costs directly, have historically relied more heavily on this kind of embedded, hard-to-see compensation to keep their record keeper paid. It's legal. It's technically disclosed, somewhere in dense fee documentation most participants never open. But it means part of what you're paying as an investment fee may actually be funding the administrative cost of your plan, and you were never shown that math in plain language. So, the 401k, didn't quietly become expensive for Diane because anyone was being dishonest. It became expensive because the entire cost structure of small plans is built to divide a mostly fixed bill among fewer people, and because that division happens in places most participants never look. Now, bring this back to Diane, because this isn't an abstract story about basis points. It's about what it does to a real person's decades of discipline. For 35 years, Diane did everything right. She contributed every paycheck. She didn't panic sell during downturns. She picked one of the most boring, sensible investment options available, a broad index fund, the exact kind of thing financial advisors tell people to choose. By every measure of personal financial behavior, Diane was a model saver. What Diane never saw, because it was never presented to her in a single, clear number, was that roughly a percentage point of her balance was being quietly redirected every year, not because of a bad decision she made, but because of the size of the company she happened to work for. She never chose that. She wasn't in the room when her employer selected a plan provider. She had no seat at the table when someone decided which funds would appear on her menu, or how much revenue sharing those funds would pay back to the record keeper. We're told that saving is a personal responsibility. Contribute enough, pick low-cost funds, don't touch it, and you'll be fine. All of that is true and worth doing, but it quietly assumes that the cost of the plan itself is a fixed, fair backdrop that everyone experiences equally. It isn't. Two equally disciplined savers, doing everything the personal finance advice tells them to do, can end up with meaningfully different retirements, purely because of a decision made by their employer, in a negotiation the employee was never part of. And the damage compounds precisely because it's invisible in the moment. A 1% fee doesn't feel like anything on a monthly statement. It doesn't show up as a dramatic loss. It shows up 35 years later as a number that's simply smaller than it should have been, with no single moment you can point to and say, that's when it happened. That's what makes this different from a scam. Nobody stole from Diane in a way she could report. The system just quietly assumed she'd never do the math, and for most of her career, she didn't. So, did anything get better? Partly, and understanding what changed and what didn't tells you exactly where you still need to look for yourself. First, disclosure rules improved, but they didn't equalize the fees themselves. Since 2012, federal regulations under ERISA Section 404(a)(5) have required 401k plans to give participants a clear breakdown of fees, including administrative and individual expenses, and to disclose the expense ratios of investment options in a standardized format. That's a real improvement. Before 2012, many participants had almost no visibility into these costs at all. But disclosure only tells you what you're paying. It doesn't lower the underlying cost structure that makes small plans more expensive in the first place. Second, litigation has pushed some employers to negotiate harder. Over the past decade, a wave of lawsuits, often called excessive fee litigation, has been filed against employers accused of failing to monitor and negotiate down high plan costs, based on their fiduciary duty under ERISA to act in participants' best interest. This pressure has pushed many companies, especially larger ones with more resources, to renegotiate record-keeping contracts and lower costs. Smaller employers, with less legal and HR infrastructure to monitor this, have been slower to respond. So, here's what's actually worth doing with this information, whether you work at a company of 40 people or 40,000. 1. Find your plan's total expense number, not just the fund's expense ratio. Your plan is required to give you a fee disclosure document. Look specifically for the combined administrative and record-keeping cost, not only the investment expense ratio quoted next to each fund. 2. Compare your total cost to the benchmark. If your all-in cost is meaningfully above roughly 1%, and especially if it's near or above that DOL illustration's 1 percentage point gap, you are very likely on the expensive end of the spectrum for your plan size. 3. Check for revenue sharing disclosures. Your plan documents should note whether the funds on your menu pay revenue sharing to the record keeper. If multiple similar index funds are available with meaningfully different expense ratios, the cheapest one that meets your goals is usually the more rational choice, all else equal. 4. If you're in a leadership or HR role, know that fee negotiation is a fiduciary duty, not a courtesy. Under ERISA, plan sponsors have a legal obligation to monitor and control plan costs on behalf of employees. This is precisely the duty that fee litigation cases have been built around. None of this requires becoming a finance expert. It requires knowing that the number on your statement was never guaranteed to be fair, just because it was legal. So, let's put the whole thing back together, because once you see it, the just save consistently advice stops feeling complete. Diane and Priya contributed the same amount in the same category of fund for the same number of years. Their fees weren't primarily driven by their choices, they were driven by plan size. Because fixed record-keeping and administrative costs get divided among far fewer people at small companies' gap, even at a seemingly small 1 percentage point, can shrink a retirement balance by roughly 28% over a 35-year career, according to the Department of Labor's own published illustration. Part of that cost has historically been hidden inside revenue-sharing arrangements between fund companies and record keepers. DOL guidance on revenue sharing. And while disclosure rules since 2012 and a wave of fiduciary lawsuits have made this more visible, they haven't erased the underlying math that makes small plans structurally more expensive. Diane didn't lose ground because she was careless. She lost it because the fee structure she was placed into was never designed with her negotiating power in mind. And nobody ever showed her the number that mattered in a way she could act on. You just learned in about 15 minutes what took her a full career to never quite see clearly. If this changed the way you look at your own 401k statement, do 2 things. Subscribe. Because next, we're going deeper into the mechanism hiding behind your fund menu, how revenue sharing actually gets negotiated, and why the safest looking fund on your list isn't always the cheapest one. And drop one word in the comments. Have you ever actually looked up your plan's total expense ratio? Because most people haven't. And that one number is worth more than almost any other financial decision you'll make this year. The most expensive costs in personal finance are rarely the ones anyone hides from you on purpose. They're the ones sitting in a document you were always technically allowed to read and never had a reason to open.